From the morning reading, small caps lead the broad index ETFs again. Oil stocks, SPX leaders, AVGO, HPQ, GAP, up on earnings per share. 7 of 9 sectors moved higher on Friday. XLB, XLU, and XLE were the strongest sectors, while XLV was the weakest sector for the second straight day. Oil futures rose $1.64 to close at $36.33. For the week, all 9 sectors moved higher, led by XLE, XLF, XLI, and XLK. XLV was the weakest sector. Breadth weakened as advancers led decliners 1.84 to 1 on the New York Stock Exchange and 1.47 to 1 on the NASDAQ. Small cap IWM again led the broad market ETFs on Friday. The SPY made its highest close since January the 5th. The broad index ETFs, spiders, diamonds, IWM, and the Qs are in a 3-week uptrend and nearing the 2016 highs made on January 4th and 5th. The past 6 months have seen a large rally, an even larger decline, then another strong rally, just like the summer of 2008. The correlation between that time period and the past 6 months is exceptionally high, and that's troubling. But it's not the time period with the highest correlation, and other highly correlated time periods didn't see anything like the disaster that ensued during 2008. An overwhelming percentage of stocks are now in medium-term uptrends, but most are still in long-term downtrends. That hasn't happened since 2011 and only a total of 8 times since 1990. Generally, it's been preceded by short-term momentum and medium-term mean reversion. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:11 a.m. Central Time, and I'm recording this in preparation for the market day of March the 7th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And in general, the overnight action saw a little bit of weakness on all 4 of the U.S. broad market indices. We're down a little bit, but not dramatically. On the S&P futures, at the time of this cut, we were down 8 points, or a little less than 0.5%. Russell futures are down about 1/3%. NASDAQ down about 0.5%. And the Dow futures are down about 1/4%. Crude oil, interesting, has been moving the other direction, and it's up about 1.5%. The euro's down about 0.5%. Bonds are down just below scratch, and gold is up just above scratch. In overseas action, China up about 0.75%. Hong Kong essentially scratch. Japan down a little over 0.5%. And Germany down about 0.1%. And United Kingdom down about 0.8%. In U.S. macroeconomic reports of note for today, you have FOMC member Brainard and Fisher both speaking. And that seems to be it for today in terms of market movers. In terms of tomorrow and looking forward, I don't really see anything there. So the beginning of this week looks to be relatively light on the macroeconomic report side. In terms of volatility, short-term VIX down below 16. Skew just above the warning threshold of 125.27. IV percentile on the S&P at 22, very, very low. Russell 24, 26 on the NASDAQ, and 21 on the Dow. No standard deviation moves were put in on a close-to-close basis on any of the 4 broad market indices on Friday. And activity in the last 2 weeks looks to be relatively normal. We normally have about 4 single standard deviation moves in a 2-week period on the S&P, and we're just about there. So nothing really to note there as well. In terms of the charts, there's a number of things of interest on the charts, and you see the overnight activity here. Let's dial this thing into the most recent week's activity. Of course, we've been doing this huge rally up off the bottom with the reversal, the 3 white soldiers, a couple bull flags, and then up we go, breaking above the cloud this last week. This was a big, very important week for the bulls, in that we got through the resistance area, confirmed, moved up above the cloud, and then we came up on Thursday to this, actually this would be Friday, to a bit of a spinning top or doji potential reversal pattern. And a lot of the weekend reading was certainly talking about a potential setup for some retracement and perhaps a bull flag pattern at the very least. If you are of the mind that this is a bullish continuation pattern and we're going to continue to move up, then you're just expecting a little bit of a bull flag, perhaps down to the top of the cloud, and then to resume the upward pattern. If you're thinking that this is just, wave 2 and a bearish longer term pattern, then of course you're starting to look for where does that short-term, very, very bullish pattern break down and we start to get a lower low. Well, unless you get down below here, you don't really have the grounds for a that this is a breaking down into a longer-term bear pattern. So as long as that low comes down and reverses prior to this level, you have to say that the short-term trend, bull trend, is still intact. So frankly, this could pull back quite a ways. It could pull back, some, let's see, from Friday's close, 1995 we'll call it. It could pull back down to 1920, so some 75 points, pretty significant move. It could pull back and still be considered a bull flag setup. So it's going to be interesting to see where this goes this week. In terms of probabilities between those two scenarios, that's really hard to tell right now because we've definitely run up against some significant resistance areas. You notice we're right up against the bottom of these cloud area here. There's some longer term resistance back here. It turned literally on the SPX like 1 penny before 2000. And then the other thing about the cash market version of the S&P is when you look at the area just above, at 2000 and just above, there was a lot of long-term resistance that clustered in that area. So that this would be an area where we'd have some retracement is not a bit surprising to the chartist out there. As to whether this is just a bull flag and we continue and we move up through that and we start to head towards the prior all-time highs, certainly is a legitimate scenario. And it's just really hard to determine at this point as to just whether the bulls have enough strength to do that, or if this is going to be something that is more like the wave 2 that others are suggesting, and that we're just about to set up into the much more pronounced and serious wave 3 down in a bear, probably a full-out bear market on the S&P. So on the Dow, we see a similar pattern here where the breakout confirmed, and then we started getting some smaller candles and then something of a spinning top, and that certainly seems to be, thus far, setting up for a potential retracement, though pretty mild at this point. It's hard to get too excited about the amount of retracement that we've had from Sunday night. It's still pretty mild and could easily be wiped out by the time the cash market opens, or even with the cash open if people come in and drive bull right away. You see on the Russell, very interesting here, we closed right at the top of the cloud. There's also some longer term resistance in this area as well. And of course the Russell, wow, I mean just flat out wow. In fact, my wife did some research on this and went back. There's 19 years worth of history on the rut, and in 19 years we never had a pattern like this right here. Let's dial this in right here. So notice in this entire stretch, and we went from 943 all the way up to 1088. So some 144 points without a single retracement candle. These 3 red candles have closes that are inside the prior candle. So while on a kind of a, literally partial day basis, yes, they were a little bit down from the prior close, but that's the most shallow of pullbacks ever. And this move here, while we've had moves that were 113 and other big runs without a significant retracement, we've never had a pattern with so marginal, just basically no real retracement, and just run straight up 140 something points. So this is historic. So keep that in perspective. This is a historic move. The Russell had a long way to go to catch up, and it certainly did it in a hurry. So whether that's setting up for something of a significant pullback to digest that kind of move or not, that probably would actually be healthy if you're a bull. You cannot sustain this kind of action forever without exhausting. And think of it as inhaling, inhaling, inhaling. The more you inhale, at some point you just got to explode and exhale. And a healthy market inhales, exhales, inhales, exhales as it goes along. And this is kind of getting to be a pretty serious and historic run there. Other things of note are crude oil. Crude oil is coming in to a very long-term resistance area. If you draw a line across the top of all these swings, we're coming right into that resistance area, right up to it. I mean, literally touching it on the knock. And so crude oil, we've had a very, very high correlation between crude oil and the market. And you see in the overnight, crude oil is actually up a little bit. So it's going to be very interesting to see how crude oil behaves up against this important resistance zone. And indeed, if it does start to roll back over, does that also correlate with the broad market indices, who are also running into their own particular resistance points? The other thing I wanted to look at was gold. And gold, of course, has had a very, very important breakout here, and has also been running against a break of a long-term trend line. So we need to continue to see how gold behaves and where that leads us to. It's a safe haven asset oftentimes, as is bonds. And bonds, you see right now, are showing just a little bit of weakness. So right now, to say that the market's going to break down in a big way isn't being told to us by the action in bonds, by gold, or by volatility. Why volatility is ticked up a little bit, it would seem right now it's calling for a mild retracement, and perhaps the tea leaves are giving us a little bit of evidence that this is just going to be a bull flag pattern as opposed to something more significant. Now we'll see how the situation develops as we go through the next few days. So a very, very interesting point in the charts, and we'll have to see where this week takes us, but it's probably going to be a kind of make or break week for some of these charts. In terms of our daily report, and as we say, market first principle, it's important that we always trade and invest in alignment with where the market posture is, and this is where we get those metrics. This intermediate term phase opinion right now is in a very bullish phase. Phase 4, price patterns near horizontal resistance, and that certainly describes us quite adequately. IBD has us with a confirmed uptrend and an improving accumulation distribution. These scores are still relatively weak, but they're certainly a whole lot better than the E's that we had not too long ago. NASDAQ's now a D+, the S&P's a C-, so pretty significant improvement on both of those. GMI index is now at a buy signal and has been so since March the 2nd. The stock charts decision points, we still have this poor stack where the short term has been very, very strongly bullish, and yet up against a more neutral pattern on the intermediate term and a bearish pattern on the long term. So that lends for a market in some transition, and indeed, if you put all this together in some sort of consensus, you have to say that we've been in a range-bound market, albeit wide range, and something of a transition where we are very much in the precipice of, is this a bull flag and we're heading to all-time highs, or are we at the top of wave 2 and getting ready to set up for something much, much more significantly bearish and ultimately taking the S&P down to a 20% plus bear market? We really are in that transition point right now to where that's going to have to be answered in the not too distant future. In terms of position sizing opinions right now, they're both relatively healthy, with one system at 100% and the volatility based system coming in at 75%. Intermediate term market posture is very strongly bullish with a weak bullish sentiment line, so that is somewhat supportive and strengthening. And you see all four of the indices are actually well up over, heck, we round this off, we call it 95 and above for all four indices. That's about as extreme as it can get. Now remember, it can stay up above 80 and remain strongly bullish for extended amounts of time. So this is not a case where you get to 100 and that calls for a reversal. Not necessarily. We can stay up in this very strongly bullish and have continuing improvement on our sentiment line for extended periods of time, and you've seen this in the past. Indeed, if you look at the intermediate trend using a 5-year weekly, you could see in the past, in 2013, 2014, and even in through the first half of 2015, we stayed, in a strong bullish trend for months at a time. Now, this indicator here gives us some indication that the current bullish trend is relatively weak, but improving. So kind of keep that in mind as well. In terms of hedge warning status, we're at 0+, so normal conditions with some elevated risk conditions. And I would imagine that we're going to learn a lot about what that might be here in the next several days to the next couple weeks. In terms of special opinions, the VIX is still above an 18 on the VIX future, so borderline acceptable. It's just above the 18, and actually the regular VIX is below 18. So borderline acceptable to initiate new positions in option income strategies for novice traders. More aggressive traders, of course, are accustomed to the larger delta and vega moves that come with that higher volatility and welcome the higher premium that's available. So just kind of be ready. You might want to consider reduced position sizing. In terms of special opinions, cover call strategies, and put selling, I really thought we would probably see some change in these ratios this week, but actually the opinion came out over the weekend still very, very defensive, and probably kind of looking at that potential that we are in wave 2 and setting up for a very, very bearish wave 3 and wanting to maintain a level of defensiveness. So certainly being defensive while still setting yourself up to make a profit off of the conservative cover call strategy is a nice way to go. Perhaps you might end up giving up some potential profits if we truly turn and start to strengthen, but we can always add to our position. We can always add more shares, more contracts, and more holdings as the situation becomes more evident. There's nothing wrong with that. It's better to be perhaps a bit slow at the beginnings of these kinds of moves in your exposure than it is to put yourself in a place where you lose significant amounts of your capital. Once you lose capital, it is very hard to get back to even. A 25% drawdown, means that you need to have something like a 60% return just to get back to even before you even start to earn real return on your initial capital once again. So consider these kinds of market conditions and the kinds of risk. Now, we've certainly come down in our risk assessment. We're at a 0 plus. So, you know, this is not where we were 2 and 3 weeks ago when it was much more elevated at level 2 and even higher. But at the same time, we're not yet in a healthy bull market. We've got significant ways to go before we can say that we've got the stack all lined up in a healthy bull market. So while risk conditions have come down, we're not quite all the way there either. There's a big difference perhaps between a 0 plus and where we are right now in that full out healthy bull market level 0. In terms of special warnings, we still had those VIX futures up over 18. That skew is just barely over 125, so about a 9% probability of a 2 standard deviation move in the next 30 days. Current week out expected move a bit elevated at a 51, but relatively lower than we've seen often recently. In terms of the bull camp, we've got lots of supporting indicators for the bullish case. New York Stock Exchange on Friday had 1,138 new highs for the 1 month time frame against only 19 new lows. You see all the intermarket risk aversion indicators are nicely, strongly risk on. In terms of sentiment, we've got a couple warnings here. The short-term risk is an 8, so somewhat elevated. You notice also gold, somewhat elevated as well. And these sectors or industry groups right here are also elevated in terms of sentiment. Now, they can be elevated for extended periods of time, so this isn't necessarily a signal for reversal. What it is a heads up. Get your antennas up, get your radar up, and be watching for price patterns that signal reversal, as these are certainly in those kind of extreme areas. In terms of fear and greed, this kind of combination sentiment index, you can see now all the way up to 71. So this continues to improve pretty dramatically, and it's starting to get not quite there, but not too far. I think this is probably 80. Maybe it's 75. That's probably 75 right there, where it goes into the extreme greed area, and we start to get on the relatively exceptional area in terms of that sentiment indicator. In terms of decision point, market posture, and key indices that are bullish, you see we have gold, the long bond, consumer discretionary, consumer staples, industrials and materials, and utilities. So this is something that we noticed last week. Prior to the beginning of the week last week, we were all intermediate term bullish on defensive sectors. But last week, we saw more of a blend come into play with the addition of the industrials, the materials, and the consumer discretionary. These are higher beta areas. And they started coming into their own with their own intermediate term bullish postures. So that is a sign of increasing healthiness for the broad market. In terms of sector percent change, again, short, intermediate term, and now into long, quite a bit of improvement here, and really not far from being able to take this to a sea of green. 1 day change, you see the most significant movers on Friday were actually a mix of high beta and defensive sectors, with utilities up sharply, but also energy and materials up sharply. So, in fact, in the top 4, you got 2 defensive and 2 risk-on kind of areas. So, again, something of a blend in that area. So I think that's probably enough for today. We've gone over 20 minutes, but we had a lot of really important information for this week. And I think this week's going to be an important one for the market. So be tuned in, understand what is going on, and watch for those signs for, where does that low come in if we do get a swing? Where does that low come in? Is that low a higher low or a lower low? That will be a very important indication as to where we're likely to go in the intermediate trend. I'm just going to roll through this next stuff. If you see something that you want, just hit the pause button and go to the hyperlink for additional details. We've gone long enough today. Disclaimers as always, hit the pause button if you need more time to review the disclaimers. You see the hyperlink at the bottom for the full set of disclosures. We'll see you back here tomorrow morning with the Falcon Global Market Preview. Good trading.